Sandra is a 58-year-old office manager in London, Ontario. Her son Marcus has lived with a severe anxiety disorder for years. He works part-time at a garden center, earns about $14,000 a year, and pays almost no income tax. When the disability tax credit was finally approved for Marcus last spring, Sandra shrugged. He doesn't owe any tax, she told her accountant. What good is a tax credit if there's no tax to reduce? Her accountant told her something that stopped her cold. Sandra could claim Marcus's unused credit herself, and she could go back 5 years to claim what she had missed. The check from the Canada Revenue Agency was just over $10,000. Here's the rule most Canadian families never learn. The disability tax credit is non-refundable. It reduces the tax you owe, dollar for dollar. But if the person with the disability earns too little to owe tax, the credit doesn't disappear. It transfers. The Income Tax Act allows the unused portion to move to a supporting person, someone who provides financial support or day-to-day care. The list of eligible supporting persons is broader than most families expect. It includes a spouse or common law partner, a parent, a grandparent, a child, a grandchild, a sibling, an aunt or uncle, a niece or nephew. A grandmother raising a grandchild with a disability qualifies. An adult sister supporting a brother with a severe impairment qualifies too. You don't need to be a parent. You need to be genuinely supporting the person. The federal DTC amount for an adult is $9,872. At the 15% federal credit rate, that reduces federal tax owing by $1,481 per year. For a child under 18, the amount is higher, $11,494, including the supplement, reducing federal tax by $1,724. Add Ontario's provincial credit, and the combined annual saving exceeds $2,000. Now here is the part that surprises most people. The transfer is not claimed on the T-2201 form. It happens on the supporting person's own tax return at line 31800, disability amount transferred from a dependent. The T-2201 does not lock in who receives the transfer. That means if circumstances change, a sibling takes over primary support from a parent, for example, the credit can be redirected to whoever is in the highest tax bracket and will benefit most. This is worth reviewing every single year. Marcus has been eligible for at least 5 years. Sandra never knew about the transfer. Under CRA's taxpayer relief provisions, she can request adjustments going back up to 10 years by filing a T1 adjustment request, a T1-ADJ, for each prior year. 5 years of missed transfers at $2,081 per year is more than $10,000 in a single lump sum. Not a loophole, not aggressive planning, a check for money she was always entitled to. What to do this week? First, check whether a T-2201 has ever been filed. Log into CRA My Account, look under tax credits and deductions. If no T-2201 exists, that is step 1. Second, if a T-2201 is approved but the transfer has never been claimed, file a T1-ADJ for each prior year you missed. Third, if more than one family member could claim the transfer, the credit should go to whoever is in the highest tax bracket. That decision is worth a conversation before anyone files. The only thing standing between most families and thousands of dollars in relief is knowing this rule exists.